What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we're breaking down something a little bit different. And I believe someone requested this video a little while ago, and I was like, you know what? I can actually do a video on this here. So what we're going to be focusing on here, and you're saying, because you probably have seen me either on After Hours, on Instagram and Discord, whatever the case is. Fridge, you do a lot of analysis of the macroeconomic world, of looking at what's happening in other countries and in the U.S. Where's the economy going? Where do we think it's going to be possibly going here? And I'm going to show you what I look for here. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and turn on your bell notifications as always for all future uploads. In today's video, we're looking at what I look for, how I track this, and how I can use the economic calendar here to help me with making investment decisions. And again, I'm not a financial advisor and I do not work on Wall Street. I'm just an average person who has done so much research for whatever reason. So what you have here is I use the Bloomberg one. There's a lot of different ones you could use here. I'm using the Bloomberg economic calendar. And what it basically does is it tracks all the different events that are happening that are reported from the federal government in terms of data here. Now, you can filter to whatever country you want. Sometimes I like to look at China's data because obviously, as we know, China and US are at a trade war right now. So I'll look at China's data to see what's going on in this case. You can look at the EU if you want to. You can look at any country that you live in, that you reside in. There's the euro. There's the EU right there. You can do whatever kind of country you're looking for to see what's going on. Again, the major ones are the U.S. because the U.S. is, again, one of those larger economies in the world. You have China, you have the EU, you have Japan. You can look at all these different ones that you would like to, and I filter it out for looking at the U.S. And again, they have a bunch of categories here that you could focus on, and the importance level. Now, the importance level for me is what I would really like to take a look at and to read through because this data right here tells you so many things. There's a lot of things that it tells you what's going on with the economic calendar, the economic data that comes in. And when people say, oh, so-and-so, this data point came in, it's coming from here or from some other, economic calendar, which it could be like Yahoo Finance. It could be Market Watch, another one. You can do Bloomberg, whatever you can find it. They're there somewhere. So what I like to do ahead of time throughout the week is I have to look to see what are major events that are coming up. Okay. Again, the ones mean that there's not a lot of volatility that's going to be expected. Twos means it's going to be a little bit more volatility, and threes means like this one would be like, moderate volatility. And then down here, we have these huge ones that you'll see here, which is the high volatility that is expected here. And those are things that I like to look at is the ones that are threes. Even the twos to me give me some indication as to what's going to be happening here. Not the ones as much. So I don't focus on the ones. I look at twos and threes for the most part to kind of see. This is the entire thing of everything that's coming out here. So you have the 3-month auction for treasury bills, the 6-month auction. You have good trade balance, which I don't even know much about. Some of these I've still kind of have learned what the market responds to and what it doesn't respond to. It kind of just depends. So sometimes it responds really nicely to, the volatile ones, and sometimes it doesn't. So it kind of just depends. So let's look through here and say, okay, what's coming up here? And I'm looking at, these ones here, HPI composite. I don't even know what these are. And you can click on here and it kind of breaks it down what it is. It's interesting that this says moderate volatility, but it says importance is 1. So that's why I don't know it. But so this one right here is a really big one for a lot of us. Consumer confidence. Now, there's a lot of reports that come out where it's consumer confidence. How confident are you? How confident am I in the current state of the economy and where we are going? This is an example. This data point right here is one where you want it to be higher than expectations. So what you will see here is you have the previous month or day or week, whatever it could possibly be, the previous week usually, or month, or even previous years. You can go even further into some of these data points here. And you can do the comparisons. So the previous month to this month, the previous week to this week, the previous year to this year. You might see Y over Y, which stands for year over year. You might see M over M, which is not mom, it's month over month. Right. So they're doing a lot of comparisons here to think about what the data is doing and how it tracks to compare it to the previous month. I look at the forecast, I look at the actual, and I see how it compares to the previous. Okay. So for example, here, consumer confidence previous was at 93.9. The estimation, the prediction, the forecast, you might want to use the word, they use forecast, prediction, estimate, whatever you want to use, was supposed to come in lower than last month. Okay, 87.7. The fact that it comes in lower than the expected, which is also lower than last month, to me signals that the consumer is still afraid. This is right here is a very important thing. It's from the conference board here. So it tells you where it comes from. It gives you the history of things. You can take a look at the history, which I think is really cool too. And you can look and see how consumer confidence has gone down. 111. Oh, that's presidential election time. That's euphoria. Up December. Okay, still pretty high. January. Okay. Tariff talks. Oh God. Oh God. Even more tariff talks. Oh God. Are we going to a recession? So like it gives you this kind of indication as to where we are going. And you can go so much further back. This is the lowest that it came in at in over a year, almost 2 years. When was the last time it was lower than this? I don't even know. We can just keep going. 95, still higher. We're coming at like 86. This is the lowest it's been in the last like 5 years. You just keep going and going and going and going and going, right? So consumer confidence is one where you want it to come in better than expected because that means people are turning a new leaf. They're starting to become positive. They're optimistic about the economy. And this tells me right away, absolutely not. So I'm like, okay. I'm looking at that saying, okay, that's not something that's really, really good here. The next thing you look at is JOLTS, which is job openings, labor turnover, is what it stands for. I forgot the S stands for. I can probably find it here somewhere, but it doesn't really matter. Basically looking at, again, the labor market, right? And where the labor market is going in this case. And as you can take a look here, again, these numbers, again, the thing is with the JOLTS report is that it covers a little bit of everything, right? Job openings, labor turnover, which is like quits, fires, and everything else. And I forgot what the S stands for. I'm so stupid right now. But beside the fact, it covers a lot of things under JOLTS. So this number isn't end all be all in this case. But the fact that it comes in lower, you would have to start to say, you know what? I'm going to look into it. I'm going to pull it on. I'm going to put on the Fridge Financials hat. I'm going to look into the JOLTS report. I'm going to say, where is it that has this number coming in lower? Why is it coming in way lower than the forecast? Is there less job openings? Is there less turnover? What is it that's causing this to go down? If you look into this report and it shows that there's a lot less job openings, to me, that speaks fear of losing your job, so people aren't leaving or doing their layoffs and stuff like that. So maybe that factors into it. This one came in higher. Oh, cool. So you have to take all this data with a grain of salt, but I'm initially starting to think to myself, this number comes in pretty low. Is it because of less openings? Because people are afraid to leave? Or is it companies, maybe not hiring right now because they're slowing down economic-wise? I don't know. I got to look into the report more. But that's what I'm looking for here. Okay, so JOLTS report, something to kind of make a note about, flag it, everything else. The Atlanta Fed GDP now I've been looking at recently. And again, if we have GDP coming in negative, that is the first quarter towards a recessionary period. We need 2 quarters back-to-back of negative. And the Atlanta Fed right now is looking at negative 2.7 as a forecast. And again, it looks back from what we have done from before, basically saying, I don't like where we're going. Again, they've done it for the last couple weeks here. So at one point, the low was negative 3.7. It's kind of come up a little bit more since then, but still coming in negative would not be good, right? And so I like to look at the Atlanta Fed, even though it's moderate volatility, I still look at the Atlanta Fed's GDP to see what they are predicting out of the GDP comes in with. And fun fact, coming in tomorrow at 8:30 is the actual GDP number for Q1. Okay, we have a lot of heavy hitting numbers tomorrow. We have ADP non-farm employment change, which is focusing on jobs, labor market, all that kind of stuff. 3. PCE, core PCE, which is a whole different thing to talk and to learn more about. We have core PCE price indexes here. Very volatile because this right here is your preferred inflationary measurement from the federal government, from Jerome Powell himself. They look at the PCE data, the personal consumption expenditure right here. Chicago PMI, which is focused on manufacturing, is important as well because if manufacturing contracts and slows down, that means less people are working. That could be a huge problem here that we're looking at. It's coming in lower. It's supposed to expect to come in lower than last month. That's not good. So this right here is inflationary values here. Now, when I say this and look at this data and say, oh, okay, well, there's some data points I want to come in higher. We would like to, what was the one I wanted to come in higher? JOLTS, I would like to come in a little bit higher. Atlanta Fed to come in a little bit lower in this case would have been amazing. Coming in higher sucks for us. But coming in lower, you want this number, you want some of these data points to be better than expected and some to be worse. For example, GDP coming in at 0.4. You want this number tomorrow morning at the time of recording this to come in better than expected. You want a higher percent here. 0.6, 1 point something. Look at the huge drop between last quarter to this one. 2.4% growth in our economy down to 0.4. I don't even know when the last time we were down this low. Oh, good Lord. It is like way, again, same thing, way back. People are afraid. People are panicking. People are nervous. People are like, what do we do here? We had a brief one here. If you remember this one, this is back when inflation hit like crazy high levels here, and Jerome Powell had to start raising rates and everything else. So the economy really slowed down here. So those are your negative ones that you're looking at right there, which obviously is different. Now, this is, let's see here. So you have more negatives down here. This is your inflation right here. This is your high rates that you had. So the economy slowed down because, again, rate hikes are to slow down the economy to combat inflation, which is why these numbers are so negative. Starting to get worried here. If this comes in negative, I don't know, man. I'm not sure what quite is going to happen. So things to kind of look at, again, GDP coming in better than expected would be awesome for us. For inflationary values like PCE, you want these to come in lower than expected because it means inflation is lower and the prices are not as high. So for core PCE, for PCE overall, for these data points, you want these to come in lower. You want your GDP to come in higher, right? So some of these values are better, some of these values are worse, depending on where they come in at. Core PCE and PCE and these inflation values are probably going to come in lower. Okay, because prices aren't going to be changed right now, probably as much, just like we looked at, if we go back and you look at the previous months for CPI data and everything, those came in a lot lower than expected because people are withholding money. They're spending less. Prices aren't being increased as much because tariffs haven't taken effect yet. And you're saying, well, fridge, tariffs are in effect and look, it's March. Again, this is March data. These data points, people have to remember, is that they lag behind a month. This is April, and tariffs just started being put into place at the beginning of April. This is March's data. So the tariffs weren't enacted here yet. So don't sit there and look at this and be like, oh my God, it's great. Inflation's down, which, you know, some people might tweet about. March data doesn't matter. April's going to matter, May's going to matter, June, July, like the next couple months, that's the data that matters. So watching these values is very, very important. So things you can look at, again, those are ones that I'm tracking at to kind of see what comes in this case. Crude inventories come in, but I don't really focus on that as much. It's about how much oil you basically have. And now the Atlanta Fed is starting to do GDP for quarter 2. So we'll see that one. Jobless claims, same thing, very, very important. Manufacturing, PMI, just like the Chicago one from before, also important for manufacturing. In this case, if manufacturing comes in lower than expected, which is like this index value right here, if it comes in lower than this, it could be a sign, again, of the economy slowing down. So it's things to kind of keep in mind about. More manufacturing data coming in here that we're looking at. Hourly earnings is very important as well, which is like how much your wages are going to be. More payrolls, which are important to look at. Unemployment rate, it's supposed to stay at 4.2. If I would be so not shocked, but I would be afraid of what this number comes in with on, what's this, Thursday? Friday. Oh boy, we got heavy hitting data all week. Employment comes in at 4.2. That's what's expected. That'd be awesome. Comes in at 4.3. Take a look at the patterns you're noticing here. 4% in February, 4.1 in March, 4.2 in April. This is May, but it's for April's data. Comes in at 4.3. Oh no, unemployment starting to get out of hand a little bit, Jerome Powell. You're going to start doing some rate cuts? I don't know yet. So this is what we look for, right? And again, there's a lot of things where it's like the major ones to look at for data points. Inflationary pressures for anything. CPI, PPI, PCE, all these are inflationary values, okay? So looking at those are definitely important. Anything to do with labor market, hourly earnings, payrolls, JOLTS reports, those are things that are important because, again, the Fed wants maximum unemployment or maximum employment with lower interest or lower inflation, right? That's what they want. They want to focus on those two major things here. So I look at those things for sure. I also still like to look at consumer expectations. You don't have any more this week, but if we were to go all the way back up to here, we can look out. Let's see if I can go back. Let's go another week out here. Let's go to, I don't know, like here. Let's go next week. So let's do next week for US. What do we got next week coming in here? More PMI, which is important. And again, those are the important ones. This one focuses more on the service side of things. So looking at retails and those kind of things, hotels, services, all that kind of stuff. It breaks it down here as to what it's going to be. Again, you want it to come in above 50, comes in below 50. It could be a shock, which we don't want. More data points here with non-manufacturing PMI. Fed interest rate decision, that's a huge one. So having it hopefully coming at 4.5. If he raises rates, that's a problem, obviously. Jobless claims. Nothing here either. Let's go like, where does Michigan consumer that Jerome Powell says is a soft data point, which I don't like. So core CPI, inflation, core PPI, or core CPI month over month, year over year, all inflationary pressures to look at. PPI comes usually right after that. Retail sales is a huge one to see what the consumer is doing. PPI data, which is producers. And this right here, I look at Michigan consumer expectations, sentiment, inflation expectations, and for the 1 year and for the 5 year. So that's kind of a look into what I look for, right? And again, you pull it up on Sunday, you look to see what comes up in the week, and then you check it to see what did JOLTS come in at? What did this come in at? I'm going to be refreshing my phone at 8:30 to see what GDP comes in with tomorrow morning. If it comes in low, that is going to be a problem for our economy, and it's going to be that first major factor to take a look at here. So this is the breakdown of the economic calendar, what I look for. And again, this is a little bit of a longer video, but it gives you some insights into where my brain goes, what it looks for, what we expect, and what we can do as reactions, right? Again, a lot of people that do trade, they trade on impulse and predicting. For me, the way I look at it is trade on reaction. React to what the market gives you. Inflation comes in lower, we can react to it. Inflation comes in higher, we can react to it. GDP comes in lower, so on and so forth. Reactions is where I think a lot of people can make money in these kind of very volatile and uncertain times. So keep that on your mind as you're looking through things here. Thank you so much for watching today's video. Again, if you made it this far in the video, feel free to like the video, subscribe to the channel, and turn the bell notifications as per usual. I hope you guys got a little bit more of an insight into the Fridge Financials mindset here. Feel free to bookmark this, look it up, whatever it is you need as per usual. I hope you guys make money in the market and you're understanding more about how the economy is working. And as always, we will see you guys in the next video.